Right, okay, we'll get cracking. So, thank you all for joining our webinar. Obviously, this is our annual accounting and tax update for accountants in industry. Ordinarily, we'd be in a nice hotel. We've had a cup of coffee and a bacon sandwich by now. Apologies that we can't do that this year for obvious reasons. But we're still putting this on, hopefully find it useful. So today I'm joined again, as last year, by Jeremy Williams and Mark Morton from Mercia, who are our training providers. Jeremy's going to do a half an hour session on the accounting updates that have occurred in the last 12 months. Mark's going to do half an hour or so on tax updates in the last 12 months. So the format as well today, you should see on the bottom, there's a Q&A button. Please feel free to ask questions while Mark and Jeremy are presenting. At the end of the sessions, we'll have 5-10 minutes where I'll be looking through those questions and asking Mark and Jeremy, and we'll look forward to their answers. So without further ado, I shall pass on to Jeremy and we'll get started. Thank you.
Great, thanks very much. Well, yes, it's lovely to be with you. Just a shame not to be with you in better circumstances than these. When I did my session with you last year, we talked through the triennial amendments to UK GAAP, so there's quite a lot of change coming through to accounting standards. Understandably, other issues have dominated this year. So we're going to be talking about the following things. We'll start off on a bit of a somber note, maybe, by talking a bit about going concern. And then we'll think about some other COVID-19 issues, including how we account for some of the government assistance and some of the other things that have come up. We'll turn to Brexit while we're on topics of uncertainty that are facing us in the future. And then if you're from a larger company, then we'll talk about the SECR. Just a reminder to, if you haven't already started the process of getting your SECR disclosures together, that the clock is ticking for that. So that's where we're heading for the next half hour. Let's start by talking a bit about going concern. And of course, the reason that we're doing this is because of the pandemic. And I think the fact that you're here on a seminar wanting to get CPD update, I'm hoping means that things aren't in a dire situation with your businesses. But of course, the reality is that for many businesses in the UK, it's been a truly awful year. And with more to come. And we keep getting statistics as to how many businesses, especially small businesses, but really of any size, are facing an extremely rocky road ahead. And it's been a very bad week for the high street, hasn't it? So I want to talk a bit about the accounting topic of going concern, because it's a query that the regulators have been dealing with. The FRC and ICAW, ACCA have been putting out guidance on the going concern basis and what we need to do. So let's just think about this from a financial reporting perspective. The main thing is that it's your job as management to make an assessment of going concern. And what's been shocking in some of the big cases that regulators have been dealing with is that management teams for some of the bigger high street retailers haven't actually done formal assessments of going concern, despite the problems on the high street that we've seen. And it's just a reminder that it is part of management's job to be looking forward a minimum of 12 months ahead on a rolling basis. And that could be a challenge. If you're an FD or an FC, you may well only have 12 months of forecasted figures for the next financial year. And you might not have projected formally figures or cash flow estimates beyond the next financial year. Well, the point at which you're preparing your accounts and the point at which Smailes Goldie is coming in to audit those will be some way into that next financial year. And you still need to be making sure on a rolling basis, you're looking at a minimum of 12 months ahead. Now, there is a minimum. If there was anything that you could see on the horizon that was likely to be a game changer for your industry, but would probably be happening in 2 to 3 years, that's still something you need to be considering. And I'm sure, doing your job as directors, you need to make sure that you're thinking about anything within sight in the future and how you respond to that as a business, because that will be with us before we know it. So the various things that management need to make sure that they're doing in any business And I'm sure a lot of this will be what's been occupying your time and your mental energy over the last few months, is thinking about the demand levels for your products and services. Clearly, if you're in kind of, retail or leisure, it's been a particularly difficult time. But for many businesses, demand levels have fluctuated either up or down. Of course, some businesses who sell predominantly online have seen sales increase quite dramatically through this time. Cash flow forecasts are incredibly important, and never more so than in a time of crisis. And it's introduced into our kind of lexicon that the phrase reverse stress testing. So just a quick explanation of that phrase, if you've heard it used and you haven't quite got to grips with it yet. A reverse stress test is the opposite of what you would normally do on a cash flow forecast. When you've got your inflows and your outflows on an Excel spreadsheet and you've got your running total of your cash balance, the normal thing we'd encourage directors to do is to flex those inflows, maybe degrade the inflows or delay them, maybe increase the outflows, and do some scenario modeling where we flex the likely cash flows, and then we look to see what the effect on the balance is. A reverse stress test goes in the opposite direction. You start with the balance and we assume that balance is zero. And then we work back to see, well, what level of change in our forecasts for inflows and outflows would need to happen in order to trigger that outcome. So how bad would it need to get before we ran out of cash altogether? So the reverse stress test ought to be your worst case scenario, and your stress test is more likely to be a kind of reasonable case scenario. And we hope that there is some clear space between those to allow you some headroom for maneuver. But that's what we expect management to be doing in companies of all sizes, is thinking about their cash flows in those two extremes, what they think is likely and what they think may happen in the worst case. And then, of course, you're thinking about lines of credit available to you, how dependent you are on your supply chain, and whether or not it's not within your business, but another business you rely on, that the problems will arise. What you do if key staff are absent because they're ill with the virus or because they're needing to look after relatives who are ill, etc. And issues of support within groups and within associated groups of companies, if you've got companies owned by the same individuals. So all of those are the kind of issues that I'm sure I don't need to tell you in huge depth about, because you'll have been spending lots of time thinking about these issues over the course of the last few months. You'll then have to conclude on the basis of your assessment two key questions, really. And the first is, do we think the going concern basis is actually right for us? And I'm hoping that if you're here today, the answer to that question is yes, it is. And we'd expect it to be yes in the vast majority of cases. You're a going concern unless there's no realistic alternative but to cease trading. And if that's the case, because you want to avoid trading one insolvent, that tends to happen fairly quickly. So, what Smailes Goldie is expecting is that the vast majority of sets of accounts that they get to see are prepared on a going concern basis. And in fact, although UK GAAP says if that isn't the case, you must use another basis, it never explains what that other basis would be. And it's been quite hard to get a feel for what we'd expect to see in those hopefully rare cases where we don't think it's appropriate. And I can recommend to you Grant Thornton's IFRS Viewpoint series. They've got a particular bit of guidance which you can find if you Google it, for preparing accounts when the going concern basis isn't appropriate. And in essence, their conclusion is you should do as little as possible. They'd avoid using a breakup basis unless you absolutely have to do that. They'd instead make minimal changes. They say here, prepare accounts on the basis that's consistent with IFRS or with UK GAAP, but amend to reflect the fact that the going concern isn't appropriate. So that means thinking about the carrying values of assets. It means making sure that we've got the disclosure. So I'm hoping that that's not an issue that you will have to face within your businesses at any point, certainly not in the near future. But we are seeing increased instances where accounts still have to be prepared for businesses, but the directors and their auditors conclude together that the going concern basis isn't right. It's still relatively rare to see that. What's much more common, if we conclude that, yes, the going concern basis is still appropriate, is the question, is there a material uncertainty about that? Is there significant enough doubt about whether the going concern was right for this basis of preparation that we need to explain that. And it's a bit circular, that. I think the point to which you think there's enough concern about our future that we're going to need some hefty disclosure, that kind of indicates that what we're talking about is a material uncertainty, which you would then need to disclose. So we're seeing more instances of that when we're talking to accountants, that the accounts they're preparing include material uncertainty disclosures. And we'd suggest that if you think that's what your situation is, that you include that phrase, material uncertainty, in describing the situation, and you explain in sufficient depth so that people who read your accounts can understand where you're at as a business, what action you've taken, and we'll talk about some tips on that disclosure in a minute. What if you're here because although it's worrying times for any business at the moment, you're relatively confident that you've got plans through this, you've got access to lines of credit, maybe you've got a revenue stream that hasn't been adversely affected by this. And so although there's some uncertainty for all of us, and none of us could have quite predicted this when we met a year ago, you know, you don't think there's material uncertainty, do you still need disclosure? And increasingly what we're advising firms of accountants is to advise their clients, yes, we expect to see disclosure. And I think our view is that anyone reading a set of accounts at the moment is going to expect to see something about how you've responded to COVID-19. So our tips for that are really avoid boilerplate text and overly descriptive narrative about the pandemic. We all know that that's the situation that we're in. Think about what's going to matter most to the stakeholders who read your accounts and be as objective as you can. Just talk about what the impact has been so far on your business, what action you've taken. That might include, you know, to what extent you've relied on government assistance, what have you done about lines of credit, and then explain what the impact has been on your basis of accounting. If you're not small as a company and you've got a strategic report, that's the natural home for this disclosure in the principal risks and uncertainties section of that report. And you could then just put a brief cross-reference into the accounting policies note within the financial statements themselves. That's what we'd recommend. And even for small businesses, we're still saying we think that would be appropriate, even though it's only strictly encouraged by the standard FRS 102. The company law makes it mandatory that you show a true and fair view, and therefore you need disclosures. So even smaller businesses, we'd expect to see some disclosure there. And we tend to think that strengthens, that improves accounts rather than weakening them, would be our view. Now, be aware that for December 2020 year ends and on, Smailes Goldie is going to have more of a challenge when they audit your businesses, when they look at going concern, because we've had a revised auditing standard on going concern, which was extremely timely in the end, as it proved in 2020. So that's going to put more onus on Smailes Goldie to look critically at the assessments that you make on going concern and to really challenge the assumptions that you've made, where you've got your data from, how you've arrived at the conclusions you have, if you've got plans to refinance or restructure, how feasible those are. So, you know, expect more challenge in your discussions with them when time comes for the 2021 audit visit based on December 2020 year ends and onwards. Yeah, don't give them an overly hard time when they start asking you questions about your assessment. Okay, let's move on to talk about some of the other issues that regulators have been dealing with from an accounting perspective in COVID-19. And for any business looking at balances on balance sheets in particular, the issue is impairment of assets. And certainly for March year ends and onwards, March 2020 year ends, where this has been a pandemic that we've been living through, we've had lockdown since March in various guises. These have been adjusting rather than non-adjusting events. And therefore we need to look carefully at the carrying values of assets on balance sheet for March and onwards year ends. And just to remind you of how that impairment process works, you're comparing the existing carrying value in the balance sheet with the recoverable amount. And it's if that's lower, then you need to write the asset down through profit or loss to that recoverable amount. The exception to writing assets down through profit or loss is if they've been revalued and there's a revaluation reserve for items of property, plant and equipment, you then exhaust that against the reval reserve first, and then you'd take any excess against profits. But the recoverable amount in turn is the greater of the value in use of an asset to your business, or its NRV, its fair value less costs to sell, which I think is an understandable calculation, isn't it? You know, I don't know about you, but we've just been in preparation for Christmas, getting our kids' toys and putting them on eBay if they're not playing with them anymore. And you have that discussion: do you still want this? Do you still play with it? You know, what's the value in use to this toy to you as a child? And if we could actually sell it on eBay for a few more pounds, could that go towards your next PlayStation game, whatever it is? I don't know if you can relate to that conversation, but that's essentially what we're doing when we do an impairment review, is we're comparing those two figures. Now, you can find out by an eBay search what the toy is worth, depending on the condition it's in. What you don't really want to have to deal with is what's the value to your child of having that toy and keeping it, and they'll probably protest that they still love it, want to play with it, but that's the hard figure to work out. And it's true of company assessments as well. Working out the value to your company of any particular asset that you own is a challenge. It should be done on an incremental cash flow basis. So we're ignoring sunk costs, we're ignoring non-cash costs like depreciation. We're just thinking about the cash return net that you get from that asset. And you might be able to do that on an asset by asset basis, or you may have to look at the business unit that asset is used by as a cash generating unit, a cash center, and look at what the deprival impact would be if that unit of business didn't have that asset available to work, if we had to hire in or buy in a replacement, or if we just lost the particular revenue stream that asset contributes to. What would that mean for us? Now, you don't have to work out value in use in some cases if it's clear that the NRV is going to be the greater of the two figures. But unfortunately, now many businesses have got indicators of impairment because of the pandemic, and they're having to dust off that calculation and think quite carefully about how they calculate value in use. And once more, Smailes Goldie will be looking at that quite carefully. It's an estimate, and to cap it all, we've got a new auditing standard on estimates that they'll be applying for the same year end, December 2020 year ends. So expect challenge from Smailes Goldie when they come to do audit work on your impairment calculations. Let me talk briefly about breaches of covenants. We've seen issues particularly with financial covenants. We haven't seen as many issues on information or restrictive covenants for companies, but financial covenants where you need to meet certain ratios on your balance sheet or earnings-based ratios. Clearly some businesses, because of the pandemic, have had a particularly unexpectedly bad year and haven't met some of those ratios. Now, let's assume that your lender is relatively benign with you about that and is understanding and is allowing you some time to get your affairs in order so we can return back to the ratios that you'd committed to. That may be all well and good, and it may mean that when you look at this from a going concern perspective, there aren't huge worries about that. Just be aware that many financial covenants have a clause which will allow the lender to call the entire loan in at their discretion. So you may have had a payment plan over a number of years, and that's what you've contracted to when you borrowed the money, but you've now got the potential for the lender to call the money in at any point. And even if they're forbearing with you, if that's an informal forbearance, then you still need to reclassify that loan as due within a year, and that can substantially alter the presentation of your balance sheet. So when we present debt on balance sheet, we don't present it based on when we expect it will be called up, but when it could be legally called up. And if that's now become the total loan, then you need to reflect that in the presentation. And that's true for any size of business. For non-small companies, you also have to disclose if there's been a breach of a covenant at the year end, that fact, and explain what was done, if anything, to rectify that since the year end. So if that had happened by the balance sheet date, then it's not only a case of reclassifying, but also disclosing what's happened. And that, you might wrap that up as part of COVID-19 disclosure more generally, but it's a specific point within 102 that we'd expect to see there. Talking about government assistance, I'm sure Mark will touch on some of the tax aspects of that, but we need to think about the accounting and the financial reporting side of that. It's usually relatively straightforward. We need to understand whether what we've received from the government is a grant or a loan. If it's a grant, we've got accruals or performance models in UK GAAP. And frankly here, because it's relatively short-term assistance that we're getting, it doesn't normally make much difference at all which model you use. I think the accruals model is the most natural one to use. So if you've not received government grants in the past, and this is the first time you've needed that kind of support, and you may well not have an accounting policy set up for it, I'd suggest accruals accounting works. Now, company law won't let you offset the grant income against the cost that it is meeting, even if that means that the accounting presentation looks somewhat odd to you. So if it's furlough grant, for example, you'll still have your wages cost gross in your accounts. You will then treat the job retention scheme income as separate income, other income, in your profit and loss account, and disclose it as such. And you can explain in the disclosure, that the two are linked, but you can't actually offset the figures one against the other. And that's a matter of company law and therefore UK GAAP as well. And make sure your policy for any grant income is clear. So in this brief session, I'm not going to spend time in detail on each of these different schemes, but CGRS is relatively easy to account for. It's a grant. We just need to think about any cut-off if you've got staff who are furloughed and who are going to be working in a period that straddles the year end, or going to be rehired, laid off and rehired again. Just we need to think about when we reflect the assistance. It's there to reflect the period in which we're getting benefit from that, which is normally the period that the wages will be paid. But it's normally straightforward to account for, as is the SSP rebate. The grant funds, the Small Business Grant Fund and the Retail, Hospitality and Leisure Grant Funds, you were eligible if you met the criteria on the 11th of March. So you won't have claimed at that date, but if you were eligible on that date, and if you got a March year end, then we think you're entitled to accrue for the income, assuming that you will apply for it because you've already met the criteria to receive it. So we're happy that you put an accrual, even if you haven't at your March year end applied yet for the grant. I think that reflects common sense accounting. CBILS is one area where there's been differing views on how to account for business interruption payment. If you account for this as part of the financial instrument, part of the loan, then the problem you have is that the interest rate that's implicit in that loan doesn't look like it's a market rate because of the effective discount that you've got, because the government's made your interest payments in the first period. And if you've got a non-market rate loan, then you might recall on IFRS 102, that means using a present value approach. Now, the Institute's published view is to do that. I have to say our published view and the ACCA's view is that if the government makes the business interruption payment for you, that's a separate matter, and that is grant income, which you would simply take as received. You'd present your loan with the gross repayments that you need to make, and therefore the interest rate within that loan, the gross interest rate, ought to be a market rate. So you don't need to worry about applying a kind of a discount to present value. You can just use the rate that's implicit in the loan itself. And I think that's more pragmatic and has got some good support from some of the big firms. So that's what we'd recommend that you do. Business rates relief, it's not a government grant. We simply just deduct that from the rates cost. So we have a reduced cost for the period in which we're getting the relief. And ETAS Help Out was relatively straightforward to account for, I think. We've had some help from the legislation. Some of the assistance that we had in the Corporate Insolvency Governance Act over the summer was temporary. So things like liability for wrongful trading has ceased now, ended at the end of September. So you do need to make sure that you are keeping on top of your forecasts. And if you're in a position where you suspect that the business may become insolvent, you need to get legal advice as to what action to take. But there are some bits of permanent change that are still around for us, including the 20 business day moratorium for companies in distress, which mirrors the equivalent for companies in administration. It just gives you some breathing space while you think about restructuring, refinancing, or where to go from here. And I'm sure you're all aware that the filing deadline has been extended. That ends on the 5th of April. So if you're original filing deadline was on the 6th of April, then you won't get any extension. That's the 6th of April next year. But if your filing deadline was the 5th of April 2021, it's been automatically extended by 3 months, which just gives it a useful bit of breathing space. Some other points briefly here. Insurance claims. If you're claiming on insurance policies, then present that separately as an asset if it's virtually certain, which I think means if the claim's been accepted and if you're just simply waiting for the payment. I think just thinking that you've got a very good chance of having a successful claim isn't enough to pass that virtual certainty test. So we wouldn't expect you to be accruing for insurance claims unless the insurer has accepted liability. Contracts of goods and services use the general principles for revenue. If you've deferred a leisure opportunity or holiday deal for someone as a holiday provider, for example, you should wait until they take that holiday before you accrue the revenue. So even if you've got non-refundable sums from customers, if you've agreed to provide them with goods or services at a later date, you should defer the income until that later date. The one amendment that we've had to UK GAAP that's really significant is COVID related and says that if you've had a rent concession, either you've received one or you've provided one as a lessor, then you take that in the period that it was expected to compensate, which is essentially as it falls. So you don't have to spread it over the remaining lease term. You just simply take a reduction in the rent expense or the rent income in the period in which that compensation is offered. Right, two more brief topics to finish us off then. One is Brexit, and we are approaching what is known in the legislation as IP completion day, the end of the year. And so all the references in the material that was published last year to exit day have been replaced by the end of this transition period. Now, within the last few weeks, we've had a letter issued by the FRC and the government to talk about where we sit at the moment. And clearly negotiations are still going on. But some of their key points are that if you're using IFRS in your accounts, you will have to use UK adopted IFRS for periods beginning 1st of Jan 2021. As it currently stands, that is the same as the IFRS that we're currently using. So there isn't currently any difference. There might over time be differences if we adopt standards in a slightly different way to the way in which the Europeans do. If you're a UK intermediate parent and you want to still carry on being exempt from producing group accounts, you're likely to be able to do so. At the moment, you use Section 400 of the Act, which requires that your immediate EEA parent files equivalent accounts in English in the UK. That will still carry on. It will just be under Section 401 of the Act instead of Section 400. So you shouldn't see any practical change, at least in the short term. Dormant subsidiaries of EA parents can't be exempt from producing group accounts. Just tuck that one away. And if you were relying on the audit exemption rules in Section 479A, and you had an EEA parent who was providing a guarantee to a company, that ceases for periods commencing 1st of Jan 2021. You'd need to get an audit done. So just be aware of that in good time. Companies House, I think, have written to everyone who was claiming 479A to alert them of that fact. But yeah, that's pretty much certain to happen. So the last thing I want to cover in the last minute or so is SECR, Streamlined Energy and Carbon Reporting. This is not really the kind of financial information that accountants are used to dealing with, but be aware that if you're a large company, for your March 2020 year ends and on, you are required to include Streamlined Energy and Carbon Reporting information, either in the Director's Report or in a separate Energy and Carbon Report if you're an LLP instead of a company. This information is not the kind of thing that accountants and FDs and FCs are used to preparing. There's a bit of a cottage industry of environmental consultants who will help you prepare SECR information disclosures or help you to verify those if you've got them from another source or if you've developed them internally. It's a mix of data and narrative, data on your energy use and your greenhouse gas emissions, and narrative about things like energy efficiency measures that you've taken, how you've arrived at the figures, and bear in mind that for next year there'll be comparative figures to show as well. So really this is a lesson that you either need to get hold of that information internally, or you need to make sure that you get on and get a consultant to help you with that information. That's subject to the same 3-month extension in filing deadlines that we've had for companies generally. So that's given us a bit more space. But, you know, those deadlines are coming in now. The statutory deadline for March year end is only kind of 2 or 3 months away. And we need to make sure we're getting on and getting our information in good time. So there we go. That was a 30-minute whistle-stop tour through what's happening in the world of accounting. Mark's going to join you in a second for the tax session, and then I'll be sticking around so we can deal with any questions and answers at the end of the session. But I'll just say before signing off, thanks for listening. Do look after yourselves. We hope that you have a good Christmas break, but we especially hope that you and your businesses do survive through this period, and that we've all got a better 2021 ahead. Thanks, everyone.
Right. Good morning, everyone. Yeah, Jess, thanks to Jess for the update on the accounting side. Tax is obviously always far more interesting, as you know. So I thought I'd just have a quick run through one or two things which are upcoming. Kind of taxation, moving on a little bit from what Jess said, the taxation position of some of the coronavirus stuff. And again, it'll be a bit of a whistle-stop tour, but if you want to ask questions or chat or whatever, then please feel free. Normally this time, well, I say normally, we've not been in normal circumstances for several years now because of Brexit and COVID, but we may have had a budget. I think the plan had been to go back to autumn budget some time ago, but for various reasons, the government haven't mentioned it. So as we sit here today, we have not had a budget or really an autumn statement. But kind of what we do know at the moment is a couple of things going forward into next year. One of them is an ongoing review of capital gains tax. Now, the government started this earlier in the year, and for a government which is short of money, I will let you mull over what a review of CGT may ultimately lead to. We've had one or two, well, like a summary document of comments. Who knows what the government will do? But I think the general moral of that point is if you were considering triggering again, please speak to your contact at Smailes sooner rather than later. But obviously, it would appear at the moment a wiser idea on a timing point to trigger it sometime soon, as opposed to possibly after budget day. But I do emphasise we have no detail. I know no more than anybody else. I'm not a great advocate of doing things just because of the tax system, but I think if you're considering doing something anyway, then sooner rather than later at the moment may be the general moral of that point. The other thing, for those of you businesses which do annually invest heavily in plant and machinery and are interested in this point, obviously the capital allowances allowance, the annual investment allowance, has been £1 million for a couple of years, and it was supposed to stop 31st of December 2020, which was an opportune time, bearing in mind Brexit possibly. But what the government have announced, albeit we've not had it in a budget, but they have made a statement saying that reduction, because it was supposed to drop down to only £200,000, that reduction will be delayed by 1 year. So if you do invest heavily in plant, then there is no timing issue. As at this December, you can get into considerable timing issues around this, but that will be deferred until this time next year. So just a little forward note to you, if you are a heavy investor in plant, etc., then please bear in mind that dependent on your year end, you can get significant timing issues with this. And hopefully next year, when we're back at the Hallmark Hotel, and I've had a big fry up before we do this, we'll be talking about the timing issue this time next year, face to face, as long as you bring your COVID passport with you, of course. So there you go. So that was a couple of things we kind of know. Other than that, we've had very little sort of lead or announcements. And to be fair, I suspect the Chancellor is considering his options, let's say, and will probably leave a budget as late as possible to see what state we're in, sort of end of winter, early spring. But anyway, that's the couple of things that we picked up along the way. The first particular issue that I've sort of mentioned on this slide was changes to construction sector, the VAT reverse charge, which is broadly to do with loss of VAT in the supply chain. You may have a bit of deja vu about this slide, because obviously it was supposed to happen a year last October, and then 23 days before it was due to start, the revenue announced that they'd suddenly realised that one or two businesses weren't quite ready, and so deferred it a year. And hindsight is a wonderful thing, of course, because that meant delayed it straight into the middle of a pandemic. Now, my apologies for my poor typing here. I did notice this before we started, but I thought I'd just leave it because it just amused me. It has not been delayed that long. It has merely been delayed until 1st of March next year. But I think for those of you involved in it, I would be surprised if it was delayed again. Because it's a money-raising exercise ultimately, and if you haven't noticed, the government are short of a few quid apparently at the moment. But also fundamentally, because I think commercially, if that's the right expression, construction has possibly been one of the sectors least affected by the lockdowns. I know there was the closure of some sites in the initial lockdown, but certainly in this second one, it's not the same as retail, which has been just told to shut and nothing happens and that's the end of it. So, I see no particular reason for various reasons why it would be delayed again. And there is a bit more information on the slides, and I know the slides will be distributed after this, but the basic point of the reverse charge is that if I'm a subby supplying my services, I am deemed to be the person who's causing the risk here. So actually, the requirement to account for output VAT on that transaction is removed from me because I'm possibly a bit dubious, and it's passed up the chain. So of course, the entity, if we call them the contractor to whom I provided my services, they have to account for that output tax rather than me, the subby. But of course, then they can deduct the same amount as input tax. So you start to see this can have a significant effect on your VAT position, on your cash flow for both parties. So 1st of March is going to come round extremely quickly. HMRC have said that actually there'll be a light touch for the first 6 months, but when you read that statement, it's a light touch on penalties. They are not going to have a light touch on you if the wrong entity is accounted for output VAT, with the consequences that come from that, as we mentioned a moment ago. So yes, any questions about this, please get in touch again with your relevant contact sooner rather than later, because there are mechanical things about what the invoices should or should not show. There is a much more fundamental thing about your VAT position and also your cash flow position. So 1st of March now is going to come around rather quickly, I suspect. So again, please get in touch if things are not clear and you are perceive you may not be ready for this. The next little slide was just a little bit of an announcement, which I found, if I'm honest, a little bit distasteful, because I got the feeling that why the revenue would announce the further development of making tax digital in the middle of a pandemic, I really do not know. If you were very cynical, you would suggest that that was because it got hidden behind other bad news. One of the interesting things about MTD was that it was ultimately a compliance exercise, which was supposed to raise money by forcing businesses to improve their record keeping. I think it is highly questionable whether that would ever work. The revenue have not given any evidence of why they thought that would work, and consequently whether it has worked or not. So personally, I'm rather sceptical about this, I have to say. And yet the revenue have announced that actually, although there'll be no more this year, no more next year, actually the next tranche will be April 22, when all VAT businesses, all VAT registered businesses will have to enter into the MTD fold. So voluntarily registered businesses, for example, which have not had to pick up the full-blown sort of IT side of MTD, will have to do so in 18 months' time. And then rather more fundamentally, April 23, rolling out for income tax, which is, again, the statement was a bit bland, and we are basing it on sort of discussions which have gone in the past. But the basic idea of that seemed to be for businesses, which would include property rental within that concept. The last idea, the revenue we're talking about, was the submission of quarterly real-time data to the revenue on an ongoing basis. Now, again, I do have fundamental objections to this, because you question what the point is. You can understand in a VAT system why information goes in quarterly when businesses are used to making quarterly VAT returns in a general sense. This is, serves, as far as I can see, no particular purpose, and yet is a huge imposition on businesses. And you would have thought, to be quite honest, at the moment, businesses over the next couple of years are going to have enough on their hands without stewing about what do we do about MTD and the associated time and costs. Just to move on from something Jess said, I've then got a couple of slides on the taxation position of coronavirus payments. Now, we had some legislation over the summer on this, and there is a basic sort of how do you tax them, and then there is a compliance aspect to this as well. So if I just show you the taxation position first, the basic point on these is that the legislation says that everything is taxable. So it doesn't matter whether it's job retention scheme, it doesn't matter whether it's the self-employed version, it doesn't matter whether they're local authority grants. Fundamentally, all of the subsidy elements, rather than the loans, because loans are ultimately repayable, but all of the grants, stroke subsidies, whatever you want to call them, are fundamentally subject to tax. And that's the basic point that the legislation puts in. Whether it is a trade that has received it, or whether it is a property business that's received it, whether it's a company that's received it, it will all be taxable as income. Okay. Now, moving on, I was just listening with interest to what Jez said. The basis of taxation nowadays is accounts drawn up in accordance with generally accepted accounting practice. So the general principle for tax would be you start with the accounts, and then, of course, as you will know, we have vast numbers of tax overrides, if that's the right expression. But primarily nowadays, the timing of income, so income recognition, is generally what the tax would be based on. So that is the general principle. So if you've recognised furlough payment within the accounts, or a local authority grant, or whatever it may be, then the taxation position will follow for that particular year end. Okay. The only exception to that is the self-employed version, where that is taxable more on a receipts basis than it is by reference to the accounting treatment. Okay, so there is an exception for the self-employed version, but the basic principle is they're all going to be taxable, and fundamentally you will follow the accounting treatment. Okay. If you're mutual and you've received one, if you're a charity and you've received the one, then assuming it relates to your primary purpose as a charity or to your mutual business, then it will not be taxable. So I think what you see from that slide, you are generally following basic, normal taxation policies. In terms of the compliance side of this, and I have to say, I have a lot of issues with the revenue on and off over the years, but I don't have any particular issue with this. The revenue have put in place a compliance process. So if I just scroll on, this is primarily for job retention scheme and self-employed income support. So the compliance aspect only covers, I suppose, for a lot of you, pretty much the furlough element. Now, basically, the revenue have given themselves a specific assessment power to say, if you have misclaimed, if you have overclaimed, we can knock on your door, raise an assessment pound for pound to recover the overpayment. So if you've claimed 100 quid too much, we will want 100 quid back. And so it's full recovery. Basically, normal assessment time limits apply to that. So if I just scroll on a minute, essentially what has gone on here is that the revenue have created a failure to notify position. So broadly, you have a 90-day rolling process. So from any of these, for any furlough payments, for any self-employed income support payments, you basically have 90 days to give it back. If it's overpaid, if you made a mechanical error in your calculation, if you find out you then didn't need it, you have 90 days to give it back. If not, HMRC can come and knock on your door. As we said, normal assessment time limits, basic assessing time limits are 4 years as a matter of default after the year end or tax year concerned, 6 years for carelessness, 20 years for deliberate errors. My personal feeling, although 4 years is the basic assessing time limit, so that's the minimum, I would suggest, if you've misclaimed it, it is careless if nothing else. And consequently, I think 6 years would probably be more likely, if I'm honest, with associated penalties, as you might expect. So again, as time goes by and you start to think, well, maybe there were mechanical errors, I think the general point of that is give it back as soon as you can give it back. There are online facilities the revenue have created to easily go back and say, I'm terribly sorry, I got this wrong, rather than the revenue knock on your door and then punish you with penalties for the privilege as well. But I have to say, I have no particular problem with that. The amounts involved are so massive that if people certainly have deliberately misclaimed, then I'd have no problem if the revenue went to every business in the country over the next 6 years and said, please could you just tell us, prove you were entitled to these things. Not in a heavy-handed manner, but just prove it. And if you can't prove it, I'm afraid we want it back. Because the amounts involved are eye-watering, as we all know. So anyway, taxation position is, generally following the accounting treatment with special rules on compliance. The next slide, next couple of slides, just a very quick whiz through. Back to the wonderful world of service-related companies, the world of IR35 and everything else. It's always good to blame somebody, so I blamed him, only in the sense that, to be fair to him, he actually started off this whole issue about disguised employment and did attempt to do something. The problem is as we know, in the last 20 years, nobody, whether it's him or anybody else, has really got to the bottom of it. And as you know, the rules on off-payrolling were supposed to come in last April for the private sector and were deferred due to COVID to this April. Suffice to say, again, for similar reasons, I would doubt very much whether it would be deferred again. And there are basically two strands to this. The revenue have said they will not generally use off-payrolling, i.e. reclassification of a contract, to say, well, hold on a minute, if you're now caught under off-payrolling, what was your IR35 position in the past? But fundamentally, we have two elements of that. We have an issue for the payer. So we are broadly looking as engaging entities, if we call them that actually, if you are a small engaging entity, you are outside of these rules. But if you are medium or large, you are potentially within these rules. And those definitions are by reference to the Companies Act. So we're talking about 10.2 million turnover, etc., etc. The basic idea of this is to look at the last financial year for which the filing date ends before the tax year concerned. I.e., if I give you a simple example, if you take the March 20 year end, for example, if your filing date was 31st of December 2020, then that would be your last year end for which the filing date falls before the start of these rules in 21-22. And therefore the consideration would be, by reference to the Companies Act, are you a small entity for March 20, in which case you can ignore these rules, or are you medium or large, in which case you've got to think a bit further about the engagements and the contracts that you have. And as you might expect, if you are, for example, part of a group, you're going to have to consider the size of the group in judging those tests. So there is an initial issue about judging whether an engagement is caught. So I think one of the things that has struck me over spending some time looking at this recently is, as an engager, one of the things to bear in mind is this is not just about service companies which you use. It could also involve partnerships. Having said that, there is still quite a lot of confusion about who should do what within this. And there are broader issues, and essentially all wrapped. It's interesting. I was talking to somebody about an LLP, and the LLP have been told that they have got to review their status of people they use next April. Well, if the LLP is small, they do not have to review anything. That the trigger from next April is these particular rules. More generally, though, we've got to do it into a discussion about who do they use as third-party labour, if that's the right expression. If the third-party labour is working for you on a self-employed basis, then that's maybe a traditional status, should they be on your books. If they're working for you through service companies, but outside of these rules, then it's a lookout for the service company because it's IR35 for them as well. So I think the initial point of this slide is, if you are an engager, if you're sitting there as FDs of businesses, then the first question for you is, are we medium? And the second question then becomes, if we are medium, we've got to start thinking about this. So again, please speak to your contact if you've not already had discussions about this. There are a number of obligations for the engager. One thing that they have to make a judgment on is the status position, whether, if you look through all the intermediate businesses, this worker is really your employee. And if that is the case, you have to tell them that they are and operate pay as you earn accordingly. Or bear in mind that if you don't believe the engagement is core, then although you don't have to operate pay as you earn, you still have to issue a statement to them. So one way or the other, if you're medium or large, you have to make a judgment whether these workers are employees really or not. So please don't think it's just about operating pay as you earn if you think they're core. There are mechanical obligations one way or the other. In terms of the pay as you earn position, obviously you are really looking to operate on the payment VAT exclusive, I think is the general moral of this. Okay. So again, just a brief reminder, but as far as we know, it's coming. The law says it's next April. The revenue guidance says it's next April. And if you are part of a medium or large entity, then please have a word with your contact about, if you are nervous about this, if you need a bit of help in making the judgments that are going to be required come next April. Just a couple of points that I'd mentioned as well. I've been talking to Peter about this from an individual, from a personal tax perspective. A couple of things. One is something that the revenue are very keen on the moment. They are making a great effort to emphasise to people that if you dispose of property in the UK, you may be taxable on it. Okay, land and buildings. Now, in respect of the disposal of residential property, we have had imposed over the last 6 months potentially another returns process. And what this basically means is, if you sell a residential property in the UK, which is not your home, then potentially you have to make a return within 30 days. Now, the return is not really about the transactional side, as you'll see from the third bullet point on here. It's about a payment on account of your capital gains tax liability for the year. So if you dispose of a UK residential property and you're not subject to tax on it, you don't have to make a return. If you have a capital gains tax liability, then you do have to make a return. So actually, this is not transactional because the revenue know from the land registry what has gone on. It is fundamentally an issue about making a payment in advance of making your SA return. So I think the general moral of this, computationally, you've got to have a think about it. I think, again, it is one of those things that is not directly part of a tax engagement, because the tax engagement would tend to revolve around the SA return, but clearly it impacts on your tax position. So again, if as individuals you are making self-assessment returns, if you're thinking about selling UK residential property, please don't get caught out by the fact that, again, that capital gains tax bill may have to be paid 30 days from completion, as opposed to historically through the self-assessment process. So we've had that come in the last 6 months, no great concession or easement from HMRC. We've also had, coming into this year, a number of changes actually to do with the rules that revolve around whether something is classed as your home for tax purposes. So if you are interested in this whole area, you may have found, there used to be a relief for a long time that if you moved out of your house for a while and let it out, there may have been some tax relief for that. The government have severely restricted that element. They've changed the rules on interspouse transfers of residential property. They've changed the rules on periods that a property is empty in the first 2 years of acquisition. And they've changed the rules that say, basically, you get the last 9 months of owning your home tax-free, which used to be 18 months and used to be 3 years. So I think that, again, there've been a lot of changes regarding residential property, whether they are your home or otherwise. And I think the moral of both of those points about the returns and this is, it's complicated. Tax is complicated. There is no doubt about it. I've just taken delivery of my new tax legislation for the current year. It now comes in 2 boxes. If I stack the legislation on end, and bear in mind this is, excluding VAT and excluding stamp duty, I would say the legislation is about 18 inches high. There's a lot of it, and it's printed basically on toilet paper. So there's a lot of reams of toilet paper that stack up to 1.5 foot, as you might appreciate. A couple of final things to mention. Again, in terms of the thing that used to be called entrepreneurs relief, which is now called business asset disposal relief for a reason nobody understands. We all know that the lifetime limit was chopped down quite a lot. But again, on the reverse side, for a lot of us, £1 million is a lot of worth to have a low tax rate on. But business asset claims, entrepreneurs relief claims as they were, are under more scrutiny from HMRC generally. And I think the thing that strikes me now with ER is, for a lot of people, you have to have all your ducks in a row for the 2 years preceding the disposal. And what the revenue seem to have quite a lot of success in is spotting errors now. Not deliberate errors, but just things that weren't quite right. So again, if you are an owner, self-employed, shareholder, whatever, it is worth just having a chat. If anything's changed in the last year in terms of your ownership position or the rights attached to shares or anything like that, please let somebody at Smailes know, because the worst thing in the world is you get an unexpected offer, you're ready to go, and then there is a mechanical error which can't be put right now. You generally need a 2-year lead time. So there have been some changes to entrepreneurs relief. It is there at the moment. It is valuable. But please bear in mind, there is generally a 2-year lead time. From businesses' point of view, two other brief things I think just to mention. One is, again, R&D. There is increased HMRC scrutiny and concern about R&D claims, but on the reverse side, with R&D, any sort of truly new, truly innovative work that has come in is potentially R&D. Now, quite how much time and cost you may have incurred on that R&D is a slightly different matter. But if it is truly new, truly innovative, then that is R&D. Clearly, as the people doing it, you and your staff are best placed to know whether you believe it is or not. There is government guidance on this to have a look at. But again, if you think you are doing new stuff, groundbreaking stuff, please have a discussion with your contact, because there may be additional tax relief available. And the real trick of this particular relief is spotting the fact that something truly new, truly innovative is actually going on. The tax then follows that potentially, but the tax is a mechanical thing. This is a scientific thing. And at the end of the day, the people best placed to know are the people who do it. So again, R&D is an area of movement. It is a valuable relief. But if you are a company doing something groundbreaking, if you're not already claiming this, then please have a chat with your relevant contact again. Okay. Final thing I put in, which is a bit of, just to finish off, a happy thought. Everything, what's the expression? There's only 2 things which are certain in life: taxes and death, or something along the lines. I may have got that quote slightly wrong. But we continue to see a number of inheritance tax claims, or cases, I should say, which make the point that with property-based businesses, if you own property, whether it's commercial or residential, as an investment and die, then you will not get inheritance tax relief on that value. And that includes furnished holiday lets. So we continue to see cases where people claim it, executors claim it, and the revenue say, no, you can't have it. And so it's certainly been an area of movement. So from a personal perspective, again, if you have investments in property, if you are interested, maybe the wrong word with inheritance tax, but if you are interested in your overall IHT position, then again, planning with IHT is always better sooner than later. Whether you want to plan is a different matter. But I think certainly if you have property-based investment, the revenue have a lot of success at the moment in negating claims. And the question then becomes, what do we do? Do we care? Do we want to do anything? Do we consider maybe passing it down now to a different generation? Excuse me. Do we consider some sort of trust arrangement? There's options on the table, but inheritance tax needs a good lead time. Couple of weeks is not enough. We generally talk about 7 years prior to death. So again, as you get older, inheritance tax is always worth thinking about. Okay, so that kind of leads to this point. So I will just have a quick. I saw the chat go, so I'll just.
Yes, it's one for you, Mark. Actually, I don't know if you can read that, but I'll fire it at you. It's. We've seen in the press some larger businesses are choosing to repay CGRS grants as they now realise their businesses have not been as detrimentally affected by COVID as they thought. Do you expect HMRC to take this point on an inquiry basis, i.e. the business correctly claimed based on the rules and guidance at the time, but perhaps in some cases may end up now being actually more profitable, not less than what they expected?
Yeah, I think... who knows what, I don't work in the revenue anymore, so who knows ultimately what criteria the revenue will use to look at. It's interesting, I think for the bigger businesses, because you mentioned larger businesses, we saw, was it yesterday, Tesco repaying local government grants. And suddenly, one or two other businesses followed, because there is, for the larger entity, Sainsbury's do not need a local government grant, let's be clear. Tesco's do not need it. It's nice to have, but they don't need it. I think with furloughing's a bit different, because certainly in the first lockdown, so many businesses suddenly went from full pace to very little. I think the first variant is going to be easier. The second one, the third versions, is a bit different because that involved part-time working. We all know there has been abuse of it. We all hear stories of abuse. I would have thought personally, as a basic trigger, if your business results, let's say your bottom line end up not particularly different from what it was last year, then you would start to question, let's say a furloughing payment. Now, there may have been good reasons, certainly in the early days, but I think the thing to bear in mind, I have on the floor to my right, I don't know if I can do this, just bear with me. This, if you can see this is, no, it's not quite coming through, is it? But I have a pack of paperwork in my hand that is about 1 inch thick. That is the legislation that goes around furlough and self-employed income support. There's a lot to pick at in there if the revenue choose to for any business. So I think as a general business principle, any business that has claimed anything should have their ducks in the row for the next 6 years if they're asked, and be happy that if they did claim it, they could substantiate their claim. And the reason that their claim was because their business had been adversely affected by coronavirus. I think that's the general point. So yeah. I don't know if that answered the question from our anonymous attendee, but I put your ducks in a row now and keep that pack of information in a drawer for 6 years, I think would be my feeling.
Brilliant, thank you. If anyone else has got any more questions, please feel free to type it in there. I've got one actually that I've heard many people ask me, and I've got a view on it, and I thought I'd ask you, Mark, as well, and that is the personal self-assessment deadline, 31st of January. Is that going to be extended?
Personal view, because we don't know, I would suggest no. Because if you've been furloughed, you've got nothing else to do other than fill your tax return in. I see no... if I'm honest, I don't think the issue is necessarily about a delay of the deadline as such, because that, from the revenues perspective, opens a can of worms. You know, if you move a deadline, I think more the issue is if you file late, will they be much more relaxed on the issue of penalties for this year? You know, will they either not impose them or possibly not collect them or accept reasonable excuse if anything to do with COVID? I think it's probably more the issue, if I'm honest. But no statement from the revenue.
Well, my view is the same. I don't think it'll happen, and in certain circumstances, the reliefs need to be in and claimed by the 31st of January, particularly entrepreneurs' relief.
That's right. Yeah, I mean, there is so much geared around, as you say, you know, deadlines, timescales, etc. I think my moral would be, you know, you've got to aim to get everything done by normal time limits. But they're not going to tell you. Let's be clear, they're not going to tell you yet. You know, give you 2 month leeway now. I don't think is what you're going to get at all, if I'm honest.
Brilliant, thank you. Well, there's no more questions coming in. I'll just quickly wrap up, and if there is one more coming, we can quickly ask it. Just to wrap up the session, then I want to thank Mark and Jeremy for your time, and I would hope that this time next year we can all see each other in person. Let's cross our fingers. Other thing then, just quickly, we will send out on the back of this, you'll get a copy of the slides. We've also recorded the webinar. I would encourage you all to check out our website. There's an SGTV section there. It's got all of our webinars on from the last year. We've been doing obviously a lot more because of the situation we are in. And also on our website, there's lots of support around COVID. It's probably a bit old hat now, but there's still things happening. So I would always encourage you to have a look on our website. Well, that's it from us. Thank you for joining, and we look forward to seeing you soon. Thank you.
Thanks.
Bye.
Bye.